When you pitch a stock to your client, to your potential employer, to your analyst or portfolio manager, or even another investor, the most important thing is to communicate concisely. I'm Henry Chien, an equity research analyst, CFA charterholder, and now online educator to investors. Now, I've pitched stock ideas to hedge fund analysts, financial advisors, fund managers, so I can tell you that the ability to communicate the opportunity of a stock both demonstrates your expertise and showcases your knowledge of how to actually invest. So I'm going to show you how to pitch a stock here and also share a free PDF of stock pitch guidelines that you can download that I'll email you with the link in the description. First thing is you got to know your audience. So for example, if I were to start talking about EQT Corporation, it's a natural gas producer, and I'm going to start talking to you about how I think it's a great growth company because natural gas is being used to power demand for AI and data centers, and they're going to export a lot of natural gas. Right? I'm going to lose the attention of a hedge fund analyst who's really just looking to understand if I'm investing in AI stocks, how are the earnings estimates changing and how do I position my portfolio? Whereas if I pitch that company to a long-only investor who does want to invest for 3 to 5 years and primarily buy stocks for their earnings growth, I'm going to get their attention. So the thing is, you have to understand that every investor has a different strategy and a different focus. So if you don't know the investor's strategy, just ask them right off the bat. What's their strategy? What do they focus on? Are they looking at financials? Are they looking at tech? Do they like value stocks? Do they like growth stocks? What's the time frame? How do they want to get paid in terms of returns? You want to ask those questions ideally ahead of time if you can, so that you can start to position your idea in a way that makes sense for that investor. Now, the second thing about a stock pitch is that it's a recommendation. You need to tell an investor what to do. Now, a lot of the new investors, they make the mistake of just giving out a ton of knowledge. Now, let me show you why that doesn't work. Hey, there's this cool company, MSCI. They make indexes like the MSCI Emerging Markets Index. A lot of funds subscribe to it because they use these indexes to benchmark the returns. Exchange traded funds or ETFs are using indexes to create the portfolio. It came from Morgan Stanley. It's the CEO is the founder. Boring, right? You probably zoned out after just a couple seconds because no one actually cares what this business does. What investors care about, what you care about, is how is this going to make you money as an investor? You want to start off with a recommendation, then a brief description of the business, then go straight into the thesis, why they should buy or sell the stock. I recommend you buy and hold MSCI stock for the next 3 to 5 years. It's a 49 billion market cap company, capital markets business. They make indexes that are used by fund managers and ETFs. Now, why? Because the entire investment industry has been shifting to use indexes. Now, about 30 to 40% of all assets are about index-based. I've seen investors use up to 50 to 80%. So there's a huge long-term growth potential in this product. Every fund manager needs to use indexes to create portfolios, whether they're index funds, ETFs, or institutional investors. So I think you own MSCI because MSCI is one of only 3 companies that sells and makes indexes. And it's a bit like a marketplace. There's only 3 because once everyone starts to use an index, very few people switch because all the investing and trading is centered around that index or that benchmark. They also have the highest margins, the best growth, because one, they sell to institutional investors who pay fees to access and use that data, so they get more revenues. And then it's also a quite low cost model for them to sell. It's a digital product. And they're also at the forefront of creating indexes for new investment strategies. So that's powering their growth. So they're in a position that I think they can grow earnings for at least 13 to 15% every single year for quite a long time. And that's how you're going to make money. So that's more interesting, right? Like, here's a tip that I learned from working with traders in the industry. You always state your conclusion first, then go into the reason, because that's the only way you can communicate with traders that have so many things going on. They have the attention span of basically like goldfish. And that also applies to almost everybody in the industry, because the one thing that everyone is short on in the investment industry is time. Now, third thing, like any good story, you need to get them excited, but you need to do it using the language of finance. This is where you can also really start to show that you know what you're talking about. Let's cut back to 2020. You remember everything was shut down. There was this company, AMN Healthcare. They do nurse staffing, and there's a lot of layoffs, right? Because people weren't going to hospitals, so there's a lot less demand for nurse labor, right? Except for COVID. So earnings were down, the stock was down, and there's just because there's less demand for hospital services. So that's a setup. Now, by the end of 2020, as the economy was about to reopen, I heard this pitch, which I thought was excellent. This is back in August 2020. So AMN, I think, is a great buy here, right? I think the stock can easily double. Why? Because when the economy reopens, hospitals will start to take in patients again. People are going to start getting procedures. That's going to drive demand for nursing, and that's going to help AMN's business, staffing business recover. Now, the stock is not pricing in much of a recovery at all. The estimates for EPS for 2021 are about $3.16. So it's about the same as 2019. But the thing is, they made a couple of acquisitions. So technically, it should be a lot higher just from those acquisitions alone. And so there's very, very little recovery priced into those estimates. Second thing is the stock's price to earnings multiple is 16 times. Now, normally it's between 14 and 25 times. So we're also at the low end of that range. So if healthcare demand rebounds, which I think it will, that would imply at least 30 to 40% of growth, at least, just to get back to normal levels. That, I think, can get to an EPS of $4.10, maybe $4.20. And they're already starting to see signs of stabilization in their business from the last quarter. So the stock also, or the business, was also growing 10 to 20% every year before, because they were expanding to manage labor for both nurses as well as other staff for hospitals nationwide. So when I layer on that 20% growth, say with the business recovering, and then you have this normal growth trajectory, I think we can get to at least $5 in EPS for the following year. And if we get to a more normal multiple of, say, about 20 times, like how the stock is historically traded, that implies a $100 stock by the end of next year. And so that's an easy double from the $50 that the stock is currently trading at right now. See, that's pretty interesting, right? Now I'm giving you a specific upside price. So that's the potential for the stock, my estimates for the business and the valuation. I'm walking you through the time frame of the thesis, and I'm also explaining the methodology of how I got there. And so then you also want to do the same for the downside scenario, exact same thing, except now you're thinking about the risk of where you can go wrong, how it can lose money. And AMN, you might notice, was a great idea because the downside was already priced in, both in terms of the estimates as well as the valuation. But now, fourth thing, you may have noticed, you want to be able to express your view and contrast it with market expectation. So basically, you want to answer, why is this stock mispriced? How is your view different from the market? And what kind of catalyst will ultimately revalue the stock? So this is more advanced and it comes with experience. And this is more of like a hedge fund pitch, because that kind of differentiated view is really how you find ideas for stocks that are going to move differently from the sector and the market. So here's an example I did a couple months ago. It's for Paylocity. It's a software company. They do like payroll and HR platform for small businesses. So I recommended buying the stock ahead of the 1Q earnings release. So the stock was at $170. I think it could get up to $200. And so that's 15 to 20% returns for the earnings release alone. And the reason why is because I think estimates are already too low, and I expect the multiple to re-rate. Now, why? Now, so the payroll industry could see accelerated growth next year. One of the reasons why is because employment growth, which had been slowing, and that's a key driver for these businesses, is now stabilizing, and it looks like it could be picking up again. The second is growth was really just slowed for a lot of these companies because they were benefiting from tax credits the prior year. So those expired, and that's what suppressed growth for a little bit. So now that's passed. So now we have easier comparisons. So that's why I think it should be a year where growth will start to accelerate. Now, I don't think people are incorporating that into their numbers. The estimates for growth are basically flat for Paylocity, about 8% in the earnings per share growth. Now, Paychex also just reported an acceleration in their business on the revenue growth side. So I think this quarter is when we're going to start to see the result for Paylocity as well. Now, the stock is already de-risked. They put out their guidance for the year. It was kind of at a low 8% rate. The stock's multiple is currently 27. That's also lowest for the group. But mind you, this 8% growth rate is still one of the fastest for the group. So I think the multiple is too low. And management, over the past couple of weeks has also been saying that I think we can get to a beat and raise cadence, meaning I think they can raise their guidance. So I think the guidance estimates are too low. I'm estimating about $7.14 in EPS for 2026, so the following year. That's a 3% upside versus current street estimates, and that represents about 11% EPS growth versus the 8% that's the market's expecting. They're already growing their client employees, so that's sort of the core driver of the business at 8%. Again, that's the fastest of the group. So I expect it to rise to 11% from the better employment environment, the easier comparisons with the passing of these tax credits expiring. And the multiple, I think when the market sees us, can re-rate to closer to that 28, 30 times multiple. I think that's a fair multiple if they're growing faster than these companies. And the catalyst that I'm looking for is in this current next release, I expect them to either to raise their guidance, and that will start to drive estimates up, and that's going to create the catalyst for the stock to re-rate. That gets me to a $200 stock when I'm using that $7.14 with a 28 times multiple. That's a 15 to 20% increase in the stock from just the earnings release alone. Now, I get that sales trends are difficult to predict. So even if it stays at this 8% type of level, right, that implies closer to $7 in EPS. If I'm using the low multiple of 24 times, right, we're getting to about 170 stock. So that's currently where the stock is at. So I think there's a lot more upside versus downside. Entering the quarter, the stock's already starting to trade up since that paycheck speed. So I think a lot of investors are starting to pick up interest, and I don't think it's priced in yet. Okay, so if you're new to this and you want to do something like this and you're pitching to an employer, don't worry about being right, because no one will assume you will be because you have no experience. But you want to put in the work to be able to articulate what you think the market expectation is and what your view is, both in a quantifiable way, so that demonstrates that you can be an investor and understand how expectations are moving stocks. And also, if you're just starting out and you're pitching to clients and analysts and portfolio managers, the better you can start to identify these expectations, as well as the key drivers and catalysts from research and price different scenarios and articulate a quantitative view, the better you're going to understand risk and the better you're going to be able to make money as an investor and pitch great ideas. Now, it also helps, just a couple other tips, to pick a good industry. Avoid stocks that are too volatile or too controversial. You just don't want to pitch a blow up. Make it easy for yourself when you want to pitch an idea. Okay, so to wrap up, putting together a good, concise pitch means first, you're going to do all the due diligence, do the research so you can actually come up with a view. Now, then do a write-up to organize your thoughts, keep it short, and then just come up with 3 good reasons to buy the stock or sell the stock. Be able to articulate your reasons with the financial model, so understanding the numbers, and then be able to also explain the positives and negatives of the business and your idea. Be able to explain why your view is different versus the consensus or market view, and then just simplify it all down so that you're able to talk about it like you're talking to a friend with numbers to back it up. These guidelines from this video will help you communicate that idea in a way that gets attention and really shows that you know your stuff. So the next video, if you want to help with the diligence part of it, I would suggest you check it out. But again, there's a link to a PDF with the stock pitch guidelines so that I can email to you below in the description so you can use it to refer to when you craft your next pitch. Plus, if you're interested in our education program for investors, there's also information in the description below. And also, if you're a student, we know you're not making money yet, but we want to still help you get there. So we're also happy to offer discounts for students in your situation. So let's get you to finding some ideas, pitch some great ideas, and I will see you in the next video. There's this trend called outcome investing, where you're designing a portfolio of assets to go around a specific return of all